Right. So, oh, excellent. So that's really good then, from
Yes.
a marketing perspective, to know that information, because then to know that you can perhaps then reduce your costs. Slightly.
Absolutely.
Your gross profit margins essentially will decrease, wouldn't it? Won't it?
It would be, but if having a high gross percentage, you can't sell the product in the market, it's no point having it.
Okay.
So even if you're getting less profit but selling more of the products,
Yes.
still getting the income coming in,
Yes. Okay.
because you've already recovered the cost, whatever comes in is the profit,
Yes. Okay.
isn't it?
Yes.
So
Absolutely. I'm just questioning.
no, that's absolutely. I'm happy with your questions, because it gives me an insight of thinking that why should be people doing that then? But you see in every shop they put something on discount at some point.
Yes.
What's the reason? Because they have already covered the cost. It's only about not throwing it in the wastage, but at least selling it for something.
Yes, and we see that in most food retailers, when
Yes.
the food comes to the point whereby, in fact, to expiry,
Yes.
they actually reduce the cost down.
Yes, but you know what is the minimum they should charge?
No.
Is the variable cost. So they can let go the fixed cost element. So this is how they decide that what should be the price of a sandwich, which was £2 but selling for 50p now.
Yes.
So the 50p is the price of the bread and the salad they got in there,
Yes.
but it doesn't cover the fixed cost.
Okay.
So this is how they decide on. So again, if we're looking at the disadvantages side of break-even analysis, we said that break-even analysis is based on an assumption, and the assumption says that the fixed costs remain constant and variable costs increase only when the production goes up, and it's constant as well. But if you look at the real life scenario, you have to make these assumptions, because fixed costs not always remain fixed. Because if I got this room to teach and the number of students increased, I need to hire another room. My rent will go up eventually. But when you look at break-even analysis, we take an assumption that fixed costs remain fixed, variable costs remain constant, just to make life easy of calculating break-even analysis. So that's taken as one of the disadvantages, but just in a theoretical way.
Yes. But even though you're right, it does kind of change. It shouldn't necessarily change by a great deal, do you think?
No, it doesn't. That's what I'm saying. They have the disadvantages, because it's a part of the question we're looking at, that what is a disadvantage, but not actually their impact that much.
Yes.
So it's still a good tool and used by many companies.
Yes.
Again, it says unrealistic technique. The technique cannot be used for control in isolation.
Right.
It is a supplementary tool. So if you're looking CVP analysis, they sometimes use in conjunction with the budgets.
Yes.
And they also use with the standard costing techniques as well.
Yes.
So they use in conjunction with other tools. So looking only at break-even analysis, sometimes as per the disadvantages, say it doesn't give you the correct results.
And maybe not give you the correct picture.
Yes.
Yes.
Yeah. So that's what so we should use more than one tool when you're looking at budgetary control.
Yes. Makes sense.
Yes, and there are many other, you can go through it. And then we come to the final tool.
So just to recap again.
Yes.
You've got these documents here, and again, I have to keep reiterating this to make sure that students read, put it in their own words.
Yes.
Please reference Harvard referencing style.
Absolutely, absolutely. And because we're looking at tools and techniques, and the question comes, how many tools should we look at for this question?
Yes.
Minimum 3.
Right.
So minimum 3, the first of them we looked at is the budgets.
Yes, but can I ask one quick question? Hope you don't
Yes.
mind. The question actually just says tools. So from one perspective, you could actually say minimum of 2.
Yes, you can say that. So we can say, okay, I'm going to give you 3.
Yeah, but-
you work on 2.
But how many would you expect the students to talk about? How many, as a teacher, how many would you want and expect each student?
At least 2, I would say.
At least
2.
Yes.
Yes, because if you just talk about budgets, so you're just using budgets as budgetary control tool, but they're talking about advantages with sort of different planning tools.
Yes.
So
Would you want 3 or 2?
I would say 2.
Okay.
I would stick to 2.
Yes.
But I'm giving you 3,
Yes.
whichever you think is more convenient.
They want to choose from.
They can choose it, because again it comes to time limit constraint, it comes to word constraints as well, and looking at all that aspect, if you can do 2 in a very good manner, explain that well,
Yes.
that will work.
Yes. And just before we start this,
Yes.
how many words are you looking for this question?
Again, we're looking for 500 words.
500 words.
So, yeah, so putting all that word in together, and you're looking for advantages and disadvantages of every tool. So, okay, so the final one we're looking is ratio analysis.
Yes.
And ratio analysis, it says, is an important tool for financial control and is used to judge the financial performance of an organization. So we use that tool for budgetary control because we look at first, we have to understand how do we calculate ratios.
Yes.
And to calculate ratios, we have to look at 2 years of financial statement.
Yes.
So if you go on any company's website and you look at their financial statement, you'll always find it's given for 2 years. And they have given the financial statement and then they do the ratio analysis for their own company as well. And how do we do ratio analysis and what is a ratio? We compare the 2 years data with what we are expecting, how much we have achieved,
yes,
and what has gone up, by what percentage that has gone up. So if we look at the sales for any company, and if we said, oh, they had a sale of 20 million last year, whereas this year the sale has gone up to 40 million.
Yes.
If I say, what is the ratio they have gone up, you will say 100%.
Yes.
So 20 million, they have gone up to 100. So the total ratio is 200% of the sale now.
Yes.
So this is what this ratio is all about. So it was 100%, now it is 200%.
Yes.
And now you're comparing and you're saying, oh, sales revenue has gone up by 100% from last year.
Yes.
We have done really well. But is looking only at the sales volume going up, do you think that's reliable?
No, well, it's not in isolation again. It's not very good.
Yes, so you look at their profit margins, their net profit margins,
yes,
and there are many other ratios you can look into.
So, just to recap of
Yes.
knowledge, so you've got gross profit margins and gross profit percentage margins.
Yes.
You've got net profit margins and net profit percentage
margins, yes.
So the percentage of gross profit is basically the sales divided by gross profits times 100.
Absolutely.
Gives you a percentage. And
Yes.
you can compare that percentage also to industry standards.
Yes. Yes,
well.
you can, yes.
And then you have the current ratio, which are current assets divided by
The current liabilities.
And then you have the asset test,
Yes.
which is current assets
Minus-
divided
you take out the
stock.
Yes, you take the
divided
stock
by
out.
current liabilities.
Yes.
And then you have the return on capital employed,
Yes.
which is
Which is your sales divided by the total capital in the market.
Yes.
Multiplied by 100.
Okay, so again, we can look at these at a standard type of ratio analysis.
Yes. So giving couple of examples related to your case study, which you think are the most relevant one for the
Right.
case study.
Yes.
So which one they are looking into as an industry standard or as comparing with the other company they have. So
Yes. So
we can
you would take about 2 or 3 of these.
I would say 2.
About 2.
Yeah,
Okay.
2, but main one, which is related to the case study.
Yes.
So giving an example of which ratios you are looking on to.
Yes. And if they don't have 2 years figures, they could always compare against the industry standard.
Absolutely, they can. That make more sense. Yes. And the final bit we are looking at is the advantages and disadvantages of ratio analysis. Again, it is a tool for management control because it tells you the strengths and weaknesses of the company itself, where company is doing good, what was good last year, not good this year, what was not good last year, good this year. So you can always look where you're going, which is the good part, and how you should improve, which is not good. Again, it helps you in preparing the budgets.
Yes.
And ratios provide a guidelines because it helps you to determine the budgeted figures. So if you know your sales this year, you know the percentage of the sales last year, you know what could be the sales for next year. So ratio analysis form the base for budgets.
Yes.
Again, it's assistance in determining financial performance. It tells you your liquidity position, your solvency position, your profitability position, and all that stuff. So if you look at the liquidity, we look at the current ratio. You look at the solvency, we look at the debt equity ratio, that how much you have borrowed from the market, how much has been invested by the shareholders. And if you look at your profitability, you are looking at your GP and net profit and gross profit ratios.
Yes.
Again, ratios are here for comparison, like you said, inter-firm or intra-firm, within the companies or with the industries or different industries as well.
Yes.
And the final is your disadvantages of ratio analysis. It says it says it's faulty future forecast because it's all based on the historical values, and it's like a financial statement, because financial statement is based, and if something major has changed in the market, they all become irrelevant at some point. Another disadvantage is it's more time consuming. You have to look for every element, get into the more detail,
Yes.
and then you have to finalize the ratios.
Excellent. So, just looking back at the question and going back to the question again.
Yes.
So the question says, explain the advantages and disadvantages of different types of planning tools used for budgetary control.
Yes.
So, as you said in the beginning, the first stage is to define what budgetary control is.
Yes.
And then next is to look at the different types of tools. There are 3 different types of tools we've gone over. One are budgets.
Yes.
The second one is
CVP analysis, cost, volume, profit, or what, break-even analysis.
Break-even
you can say that.
analysis.
That's another name of break-even analysis.
and the third one is ratio analysis.
Yes.
And then in budgets, you would talk about the different types of budgets.
Yes.
And then you would state the pros and cons, the advantages and disadvantages
Yes.
of budgets.
Yes.
And then you would talk about the advantages and disadvantages of break-even analysis.
Yes.
And the advantages and disadvantages of ratio analysis.
Yes.
And so what you're saying is that obviously these are the planning tools, and also your college or your institution will give you a case study.
Yes.
So this needs to be in relation to
The case study, absolutely. The examples you're giving out, for example, in ratio, you're giving the ratios out, so it should be related to the company. Again, if you're looking at the break-even analysis or the budgets, what budgets the company use, they normally reveal that.
Yes.
That what budgets they're looking into for specific case study.
Yes, excellent. Well, that has been fantastic. So I think you really answered that question diligently, and you're looking for about a minimum of 2 types of
Planning tools. Yes.
tools, and you're looking for about 500 words.
Yes, absolutely.
And everything needs to be referenced according to Harvard style.
Absolutely.
Thank you very much.
My
Let me
pleasure.
just shake your hand.
Thank you.
Absolutely amazing.
Thank you so much. Thank you for having me, and it's a pleasure being
Thank you.
on your channel.